how to actually make money in the cryptocurrency market. Wait, don't click away, as this might be one of the most important videos explaining to you a very effective dollar cost averaging method that I've been using, and it will hopefully improve your investment strategy. So if you're a new investor, then this is a must watch for you. I'm Kieran from Crypto Bulls, and I'm happy to have you here with me today. First of all, we've got the cryptocurrency. As you may have all seen, in 2017 we had a massive run up. However, cryptocurrency, when you're talking about Bitcoin especially, did not start there. So we've had very, very low prices at the beginning of 2009, and the prices make you dream of a better life if you could have bought at those prices, of course. So in 2010, Bitcoin was around 9 cents, and 2011 around 30 cents. So imagine buying a few coins at those prices. That looks like XRP prices. Nevertheless, I'm just going to try and show you one concept why I believe it's going to be very difficult for every investor who is investing now to hodl through the whole bull run until the next all-time high. And I'm going to explain to you why. So imagine you've bought a few hundred or maybe even 1,000 coins in 2011, and you experience the growth. So that's the same scenario. So you've got XRP now, and XRP will go to $4.97, which is a staggering amount. The growth is just mind-blowing. It would be like 1,655% of growth in the matter of a year. Now, of course, there's this funny psychological thing. If you would, like, after you took those profits, you would have never heard of what happened in the cryptocurrency market and Bitcoin afterwards, and you probably be very happy. However, there's a psychological aspect to humans that make us compare with lost gains and so on. So what likely would have happened is you would have compared and you thought, oh, you missed out on all the gains afterwards. So definitely a few thousand, I think like around 300,000% or something like that. So that's that. And the thing is, it will be very difficult for normal investors to just buy and hold all the way through and not touch a single coin. And of course, that's definitely not something you should do, because I'll be talking about how to exit. But I just want to put in perspective that it's easy to think that at the moment the price is at a certain level, and it's just certain price points which get thrown around. They seem just so far and beyond that you just can't imagine it. So there are some blog posts where people mention $1,000 Bitcoin and so on. So imagine someone mentioning $1,000 Bitcoin when the price is around $2,011. That's the same thing as saying a $50,000 Ethereum or something similar like that. People just think you're crazy. However, when it happens, then the bar gets set at a new price point and everything else is possible. And I think this is a very important notion to just keep in mind for the next bull run, because I believe many people are going to find it very difficult to hold through all the rises and dips during the next bull run, and they're going to do one mistake that many long-term investors do, and that is try to time the market, like buying at a certain price and then hoping for a bit of a correction, selling their whole portfolio or whatever, and then trying to time the market and buy back in again. What very often happens is that during this phase, which should be the accumulating phase, you shouldn't sell, and they try and time the market, and afterwards they buy back in at a higher price because of FOMO. Now, talking about different maybe guidelines or strategies where you can use higher risk investments, I think this is a very good example to highlight this. So this is the speculative investing framework from Financial Samurai. And here you just overlay. So if you're an investor, you probably have a very diversified portfolio with some lower risk investments and a certain percentage of a very high risk investments. And I'd guess like the very high risk investments would be around 5% of your portfolio. And here's just an example of your, if you've got a portfolio that's around maybe $650,000. So let's say someone who's had a very successful career and he's bought in different portfolios. It went well. You've got a very nice portfolio, and you could invest a small percentage of that into, for example, cryptocurrency. I'm not too familiar with the other ones like options, angel investing, but that's beyond the point. Now, let's say you invest in one very speculative asset, such as cryptocurrency. Then, of course, you've got many options. First of all, you've got the potential that you lose all your asset. It goes down to zero, like we've seen in the last bull market when people bought in and then they huddled down to like minus 90% and so on. However, you've got an enormous return on investment possibility, which is not seen in anywhere in other asset classes, apart from maybe gambling, but that's not the point. So there's a very high risk, but in my opinion, a much higher return on investment, which justifies the risk. Now that said, please do not invest your life savings into Bitcoin like this user posted 1 year ago. And as you can guess, this probably went really bad. So just took out a mortgage on my house to buy BTC. I'm all in, so maybe that's a troll account, I don't know. Hopefully, Fiesta Boy 69 is still having a fiesta and is not regretting his life decision. So now talking about this investment strategy. Now, of course, dollar cost averaging, it gets thrown around a lot and so on, and it's definitely a very good strategy to use. However, in my opinion, with a small addition to the dollar cost average, I've got two different strategies. You can either use one or the other or both together, and that will definitely improve your dollar cost averaging, because you'll be buying the lows instead of the highs. And how to do that is the first one. Here we're on TradingView. It's free. You can register, you can make a site, and you don't have to buy the pro account, so you can use it for free. And the first strategy that we'll be using is with the relative strength index. Now, as a quick explanation, the relative strength index indicates how much the stock, or you can also use it in the stock market, but how much an asset has been overbought and oversold. So the rule of thumb is, as soon as the stock is below constantly below the 50 mark, then you consider it a bear market, and it's more like an equilibrium. But everything below, then the stock is oversold, and everything above the 50, the stock is overbought. So price points like 80, 90 and so on, there should be a no-go for buying anything. However, now the strategy I want to show you, you can either use it on a daily time frame or the 4-hour time frame. You can find this indicator by clicking on the wave with the plus sign. You can click here and you can select, and you write here RSI, and here you've got the relative strength index. It's the first one, nothing fancy, but very powerful. So let's get rid of these nice yellow bars. Now, one thing, it's when the price is moving, you're not going to get a perfect bottom, and you're not going to always get the bottom perfectly. But with this strategy, hopefully you'll be buying more or less at the lows when you're dollar cost averaging, and not just randomly, like for example every Monday or every first day of the month and so on. So first of all, make sure you've got an investment plan. Decide how much money you want to invest into the market, which percentage of your portfolio you want to have in the market, and then decide over which time period you would like to have it, like maybe over a year, how much each month. Now, of course, the more like the more you split up your buying, then the possibility that your price, like your average price, is lower, the probability is much higher. Now, with the chart in front of us, so we've got here, I'll just show you a few examples of where I personally bought and accumulated. And I'll show you afterwards the other strategy which you can use in combination. So you can use both strategies together, and it's just something you can quick look during your break maybe, and you decide if now is a good time. Now, what I suggest is you can take your cursor and put it over the horizontal line, so you can draw a horizontal line. Let me see, is it working? Yes. And you can put the horizontal line at the 50 mark, and that might help you visualize it a little bit. So as I mentioned before, when the price is trending above 50, it's probably the beginning of a bull run, and the price will bounce always back down on the $50 the 50 level. And as an example, if we start our dollar cost averaging, let's say I want to start accumulating, and I would like to start accumulating maybe on the 21st of October. So now I would be not doing much at the moment. I would look at, one thing you should do is maybe look at the past few months to see what the average is. Now, if everything is much higher, you probably look for some pattern, like a certain type of support where you would find a good entry. So here, as an example, 36 looks like a good entry on the RSI. So maybe I might try and find an entry at 36, and here we are very close to 36. It spikes down, and then here maybe I would have bought my first entry, my first position for my cryptocurrency investment. Now continuing, now we peak down below. Maybe we have our next investment, and so on. So always when the RSI is lowest, you'll be dollar cost averaging and increasing your portfolio. Now, you won't get the lowest price. That's very difficult. However, hopefully, if you have no clue about charts and no clue about long-term investments, you will not be buying, for example, based on your emotions. So you won't be buying here where after the price just rose a lot, or you won't be buying at the tops, and you'll be more likely buying at either the average or below average price. Now, this is a quite easy one to use, as well as the next one. And the next one is very, very interesting, one of my favorites, especially when you use it with the RSI in combination. So first of all, here we've got the daily time frame. I suggest either the daily or the 4-hour time frame, and you can use these both in combination, and that will hopefully help you find the best market bottoms for your dollar cost averaging strategy. And me personally, this is what I use when I accumulate. I'm in the accumulating phase. I'm not even considering timing the market, because I just don't have any time to first of all, I don't have any time, and I just don't want to risk it. I don't want it to be day trading, or I don't want to try and time the market and potentially miss out on the next bull run or next push upwards. So here we've got the CMWF V3, and this you can find also under the wave. You click it, and then you type in CM underscore. So you got CM underscore W, and you've got the Williams VIX Fix V3 Ultimate Bottom Market Finder. And I think it's a fantastic indicator. And as I mentioned before, even though I personally use them, this is not financial advice. I just wanted to share this with you because I'm using it, and I want to help as most people as possible not to make the same mistakes as many other new investors did at the end of the last bull run. So the CMWF indicator works with Bollinger Bands. I made a video about Bollinger Bands. If you want to look at that, put it in the description below. But you don't need to understand Bollinger Bands for this indicator. The only thing that you have to understand is what the gray lines and these green, sorry, I'm a bit colorblind, and these green lines mean. So basically the green lines is the deviation, so how far the price is from the average. So when the price is very, very high away from the average, then these bars become green. And when the price goes back to the average, or the average comes closer to the bars, then these bars here get gray again. So you probably guessed what the strategy is. So here, every time that the bars go gray, you dollar cost average. And of course, hopefully you don't start dollar cost average at the beginning, but more like around the 6,000 US dollar level, around there, because very often at the beginning of a bear market, the volatility is very high until that you reach a certain sideways trading with very low volatility, and here you can already start accumulating. But here, actually, if you look at the bars, I wouldn't start accumulating here. However, as soon as we have our first drop, you can already start putting your first small investment. Maybe it's $100 US a week or something like that. That's up to you, how much you're willing to invest and potentially lose. And then you'd have the next investment. And it's possible with this method that you might be investing 4 weeks in a row, and then maybe 3 weeks nothing, and then 3 weeks in a row, or 1 week in a row, and so on. And then afterwards we continue here, and on the 29th of January 2019, you would have had another investment. And then again here on the 1st of March. And yeah, maybe even though you might be buying a little bit at a higher price, hopefully if you used these two methods there, starting from the 11th of November, then you would probably have around a buying price of around maybe $4,500, around that price point. Hopefully I made it clear to you how you can use these two strategies. If you've got any questions, or you don't understand one aspect, don't hesitate to leave a comment. I'll gladly respond and hopefully help you. Now we talked about the accumulating phase, and we'll get to a very important topic, and that is exit. Now, it doesn't really matter if you buy and buy and buy and you never sell, because many people just did that. They waited for the last bull run and then they hodled all the way down and they lost all their gains, and that is definitely not a very good strategy. However, as I mentioned before, it's very important not to try and time the market. However, what I suggest is the following, and that's in my ultimate beginner's guide to cryptocurrency investing. I made a video on that. You can look it in the description below. And that's about taking profits. And the difficult part about taking profits is twofold. Like I mentioned all at the beginning, is many people are emotionally invested and are scared of future lost profits. The price rises 100x and you just missed out on that. And hopefully with this profit-taking strategy, you will get a lot more return on investment, hopefully a multiplication of your initial investment at the end, and even have some cryptocurrency left. That's it. So taking profits is definitely not easy. Everyone is scared of the coin going up 10x more than it already has, and that's because people are greedy. I've been found guilty of that as well. I didn't sell certain projects because I was controlled by my emotions. But this is one very important strategy, and hopefully you can use it. So when you're creating your investment strategy, make sure that you also think of a price where you feel like, okay, I think that price is good, and I want to start maybe selling a portion of my portfolio at that price point. And as soon as you got that price, it might be maybe at $5, $10, depending on your average buying price. And so this example, we've bought 18,500 coins for 5,000 US dollars at $27 a piece. So this could be Bitcoin in 2011 or 2010, and that's it. We've made this investment decision, and then we wait. We're patient. It goes up, and we decided at the beginning we will be starting to sell at maybe $1.30. However, the time passes very fast, and the $1.30 mark comes around, and it's time to sell. Now, of course, now you have to actually follow through with this strategy, otherwise it won't work. So when your cryptocurrency that you bought reaches $1.30, I sell 3,846 coins for 5,000 US dollars at $1.30 a piece. That means, first of all, I've got my initial investment out, so the rest of the money that is in is pure profit. I still have 14,650 coins, which is valued at 19,000 US dollars. So already a very good return on investment. Now we wait, continue. We don't know if the price is going up or down. However, it's fine since we already got our initial investment out. Now you can change this strategy however you feel fits, depending on the price. And you can maybe say, okay, I'll be selling as long as the price is underneath $10. Every $10 or 50 cents mark, I'll be taking out my initial investment. So now the coin goes to $2.50, and I sell 2,000 coins for 5,000 US dollars a piece at $2.50 a piece, and I still have 2,654 coins left, valued at $36,000. So I still have $36,000 in pure profit. Now it continues to go up. This is a beautiful bull market. Everyone loves that. And I decide to take out the same amount again when it reaches $4.20. So I sell 1,190 coins for 5,000 US dollars at $4.20 a piece. So I still have 11,464 coins at 48,000 US dollars profit. Now I hope you understood the name of the game. Basically, I'm always taking out my initial investment, or the initial investment amount, and the beautiful thing is each time that I do it, I'm selling less and less coins. Now, of course, at the beginning you might be selling a bit more coins, but the higher the price gets, the less coins you'll be selling. And maybe you can change it up a little bit. So for example, after maybe like $10, you can just maybe take out the initial investment, 5,000 US dollars, maybe for each 5 US dollars that the price goes up. And maybe when the price is maybe $50 or $100, then you do it every time the price reaches $20. So of course, maybe at the end of the bull market, you might only have 20 coins left. That's possible. However, in the case of Bitcoin, if you'd have 20 coins left at 19,000 US dollars a piece, then hats off to you. And that would have been one of the best strategies to use from the beginning of the bull market until the end of the last bull market. If you're talking about the lowest price to the highest, even though there are many highs and lows in between. Now, after you've done that, you've got a lot of cash in the bank, a lot of cash to buy back, and then you can think about your buying back